when we go into the due diligence, we think there are potentially two big disrupting factors: digital technology and now the environment.
That's Jean-Remy Rousseau, a managing partner at CVC, which is a private equity firm that has gotten ahead of the curve on ESG.
The environment, if it continues to change, can have a massive disruptive impact to the sustainability of your company. In the same way as technology, 5 to 10 years ago, we thought it was sort of a long-distance threat.
What you're about to hear is what I consider one of the best, most practical explanations of why ESG makes sense for everyone, from investors to managers to employees to society at large.
It's not a trade-off. It's not a risk management litigation issue. It is not a conformance to regulation. It is a unique opportunity.
Today on the show, I'll ask Jean-Remy to explain how CVC views ESG not as a gauntlet of threats, but as a series of opportunities. He'll explain how CVC pursues these opportunities to improve operations, win market share, and exit with higher multiples. And he'll refute the notion that ESG necessarily erodes the bottom line.
There's no trade-off.
I'm Hugh MacArthur, head of Bain's Global Private Equity Practice, and this is Dry Powder. Jean-Remy, thank you very much for stopping by the show today. We appreciate you coming.
Pleasure.
We're hearing a lot of our clients talk about creating an ESG strategy, but at CVC, you've really been ahead of the curve on this issue. What made ESG a priority and how you put that into action?
Hugh, we developed years ago with you guys an approach of building better businesses. And the two components of building better businesses, which is going to be the exit multiple and the improvement in the financials. And we looked at those two, and you can improve the percentage EBITDA, the cash flow, but if you are improving the multiple on exit by 20, 30, 50%, you got an exponential return all of a sudden. And we looked back at the home runs we made, and we thought, okay, what's driving the multiple increase? People will be willing to pay more money when the company is able to gain market share and to be able to grow ahead of the market consistently and sustainably. And as you know, you get a big multiple uplift for growth beyond the market growth, much bigger. And we looked at that and thought, how do you get your company to grow market share consistently? We developed a framework, which is our value creation plan, and we integrated ESG and CSR factor into it.
It's fascinating that ESG actually can help drive performance and then therefore enhance the exit multiple. If we go back, Jean-Remy, to basic terms, how would you actually define ESG at CVC, and has that definition changed over time?
So the definition of ESG has not so much changed, the focus has changed. In our framework of value creation plan, we have 6 components, which are customer focus, operations efficiency, employee culture, community, environment, and governance. So with employee culture and people engagement and community, you have the S. With environment, you have the E. In governance, you've got the G. But for us, we've added C. C stands for customer. And the C is the cornerstone of our value creation plan. And very early on, we worked to develop NPS, customer insights, because we figured out that the way to get incremental growth in the market is to have the best product and service that the customer wants and is willing to pay for. But very, very few companies have data on that. Constant feedback loop, churn analysis, customer complaints. This is non-financial reporting. It very rarely makes it to the top. But if you have a company that has the best product and customers are saying, thumbs up, this company has really made some significant improvement, your company would be worth more. And if you could trace the NPS improvement, the churn reduction, the quality improvement, the trust of the customers over time through surveys, your company will be worth more. So the C is an essential part when I talk CSR and ESG, corporate social responsibility. A big responsibility of our CEOs is to make sure that we sell the right product, the best product the customer can trust and not have to read the small prints or trying to game the customer, because this backlashes very quickly on you. That's a key element. So we've always integrated NPS, in the C. What has really changed the focus on the E, the environment. And here, where we are now, when we go into the due diligence, we think there are potentially two big disrupting factors: digital technology and now environment.
Should ESG determine the kinds of industries and companies you invest in then? Does it drive your screening?
That's a very, very good question. It's something which we are wrestling. We had a CVC board meeting with that topic, and we are not yet conclusive. And let me give you a few examples. If we flag one industry, for instance, we're doing energy production, and there's a couple of coal plants, then we don't invest. Another part of our investment committee said, well, maybe we invest and we close it and we push renewable energy. Which one is better? Or if you need to take a company and restructure because it's just being outdated and there's chunks of plants that need to be shut down, do you say, well, sorry, because of the S, I'm not touching it? Or do you do the work and retool the company, retrain new people, and actually, when you leave 5 to 7 years later, you've done something very good for the industry and for that company? Big philosophical question. Which way do you approach? And personally, I would move away from some bad ones, of course, clearly bad, that you say this is just only downside and has been badly done and we don't want to be associated with that. But if you think that you can make bad better and good, I think it's part of our duty. If you can make a good return, and that's also an important element, I would be willing to engage myself and shut down those 2 coal plants and deal with the retooling of the people and treat them well on the retirement plan and reinvest somewhere else so that the company can exist and provide good living standards to many families again.
It certainly makes a lot of sense to me, Jean-Remy, to take something that perhaps isn't quote unquote good and be able to make it better. And that's certainly making the world a better place. If I could give you a theoretical example outside of the coal plants, we have plastic packaging companies all around the world. And of course, plastic winds up in the oceans and causes lots of problems. But I don't think plastic packaging is going to go away anytime soon. It's kind of a fact of life until we get a new technology. So would you consider, for example, buying a plastic packaging company and making it the most environmentally responsible plastic packaging company it could possibly be? So it's a top rating. Is that something that you would view as kind of taking something that's not so good and making it better?
We have a company called AR Packaging in the Nordics, and that's exactly what we've done. We moved to added value, more renewable plastic. And we have Bosch Packaging also, which is doing machines for the pharmaceutical industry and consumer goods for the higher end. So yes, absolutely. We've had that discussion. Some of us in our investment committee said precisely your question. And we said we believe that we can make renewable packaging more affordable, move into more product categories in consumers in pharmaceuticals. So actually, we will be contributing. But buying a cigarettes or alcohol company, we don't. It's not something we would do.
That's fascinating, Jean-Remy. So you mentioned earlier that ESG can really help drive share gain and therefore EBITDA and financial performance. And I'd love for you to talk for just a minute or two about it. We talk about value creation plans, and for many years, you've got a value creation plan in place. And once you buy a company, you go and talk to the management team about how to implement this value creation plan. If ESG is increasingly becoming part of those value creation plans, how do you make that operational from the boardroom to the front line? How do you engage with the management team and say, these are the things we need to do that are potentially non-traditional for you, but it's actually going to enhance the performance of the business? How do you make that real?
First, we explain that we are going to improve the value of the company, which is a question of multiple plus financial improvements. And they're interested, and then they say, but how do you do it? And again, we start with our model, with the 6 modules. The first one is customer, and we talk probably 70% of the time, we collect data on customer satisfaction and what's the gap between perfection, fantastic customer satisfaction, no churn, and where they are today. 9 times out of 10, it's an eye opener because the management team don't know, or they think they know, but they don't really, because they made inward focused decisions and the company is not turned to the customer. And so I speak about, let's find out from our customers how we can make this company even better. And that's the first point. Nobody can argue against that, right? It's not threatening. You're not talking about cutting costs. Then when we move to operations, once you know what's important for customers, how to improve the quality of what you're offering, service or product, it's easy to see where you should invest. And to get the money, you're removing waste, you're removing things which are in the middle, not lean, in order to serve the customer better. You flip the company upside down. So then people say, okay, yes, we're going to make more efficient. Then from the employees, we take a stock of the employee engagement. And one subsidiary question I like is, would you recommend a friend to work for this company? When you have a company at which 68% of the employees said, I would never recommend a friend to work here, you know you have a problem. And so I'm talking to management about the customer and the whole force that's going to deliver the change that we want. And if this engine, you think about the 6-cylinder, is running on 2 and 4 are disengaged or stopped. So talking about those two things, customer and employee culture engagement, is already a big part of the ESG or CSR. Big part. Mm. So we take a snapshot of NPS in churn, we take a snapshot of employee engagement. And then we say, your bonus will be depending on this going forward. We'll have a base on financials, but your big part of your bonus is going to be dependent on improving those two criteria. All of a sudden, you put management into a different frame of mind. And they say, I've had one who says, yeah, but how about EBITDA and percentage? I say, look, if we are gaining market share and increase volume, and if employees are engaged, we'll have less churn, more retention of highly qualified people, and more engagement, therefore more chance to succeed at implementing things, the financials will come. Financials is a real mirror view. Those are lead indicators. And when it comes to environment, we're quite pragmatic. We take a snapshot of resources consumed, energy, waste, impact in the environment, and we say that's point of departure. How do we improve? And we've got many examples of projects where we've been able to reduce energy, reduce waste, which has a big benefit in the P&L or the balance sheet, and actually reduce the negative impact. That also, when you're an employee and you see that you're trying to do the best you can on product, so you can be proud of what you sell, at the same time looking at the impact that you have on the environment, decreasing it, and motivating people internally, you know that if you've got those criteria, share up, NPS up, churn down, customer happy, engagement of people going up over time, so you think your workforce is more engaged, and impact on the environment diminished, potentially offset with some savings that you can reinvest in growth, management get it very quickly, and financials come. Eventually the financials will come. I would even argue you that if you increase a little bit the financials, or even degrade the percentage EBITDA, but show significantly higher growth, your multiple will more than compensate.
That makes perfect sense to me. And it's fascinating how you actually link the elements of customer and ESG to the financial performance of the company, and then incent management by rewarding them on those inputs that actually drive EBITDA rather than purely on the output, which is EBITDA.
That is the key. When you come to sell a company, and you show those non-financial KPIs, and you say, this is what you buy. I tell you, the buyer's like, wow, they expect private equity to squeeze cash and squeeze everything, and you show that, that's what you're buying.
On the next episode of Dry Powder,
I said, okay, why don't you come back with what you think should be done to have the best product in the market?
Jean-Remy Roussel explains how CVC executes on an ESG strategy, from the C-suite to the front line.